Hello everyone, welcome to Chill Deal Trades. Thanks for coming to the channel. I cover everything happening in the stock market, breaking both down the fundamentals and the technicals of both specific stocks I like and how the market's looking overall. Please like and subscribe if you find anything in this video you like, but let's get to the content. So today we're going to be talking about Michael Burry. So he's made some crazy predictions about what's happening in the market or where he sees the market headed. He's saying we're going to see the largest crash we've ever experienced in the history of the US, where housing, currency, and both the stock market basically get wiped out. And as you see, one of his most recent quotes, or one of his tweets, I should say. Thanks for coming back to Twitter, Michael. But people always ask me what's going on in the markets. It's simple. Greatest speculative bubble of all time in all things. So he's saying it's the largest all time. What do you guys think? Please write something in the comments. I want to hear your perspective about Michael Burry's opinions. So the first thing we're going to break down is kind of reasons that show Michael Burry's prediction might be correct. We're going to both look at kind of what the Fed's doing, the stock market, as well as investors. So the first thing is just how expensive PE ratios have been looking. So what we're seeing here is PE ratios are the second highest they've ever been in history. The only time they've been higher is during the dot-com bubble, which was obviously a crazy speculative time. So this is just something to call it here. It's really expensive. The Shiller P ratio averages at about 17 to 18, and so we're more than double what is considered the average PE ratio on this indicator. Also want to look at earnings. So obviously we've seen earnings of companies have grown over time for the S&P 500, and what we saw this giant increase here after COVID, because people were starting to see this crazy growth, specifically like more on the digital side of things for their companies. But we have seen this come down some, which is something to look out for. Is this going to head lower? Is it going to come back up some? Have we kind of reached a point where we need to start looking at if earnings are going to continue to grow, or if they're going to start coming down some as maybe the economy growth slows overall? Now I want to look at kind of the Fed. So as we see, is the Fed's debt has been the largest in terms of percentage of GDP since 1950. So that's insane. And basically what this tells us is the Fed has had to grow their debt in order to help the economy grow. A lot of times we see the federal spending and the federal debt correlate with the stock market. And so what we're seeing here is we're at really dangerous levels for our country. Countries that have these kind of high ratio are like parts of Europe. Portugal has really high. Countries that Spain has really high. Basically, countries that aren't doing so well as an economy typically have really high federal debt rates as a percentage of GDP. So if we see this stay up here in these 70 ranges and we don't see it come down, this could be a red flag about a dooming economic and stock market crash. Fed spending has been insane, so we call it QE, which is quantitative easing, and we're seeing all-time highs, levels we've never seen about, but the Fed has talked about tapering. We don't know how much, we don't know when, but they said they're going to start cooling off their purchasing and eventually reducing their purchasing. And why that's important is when we look at history, the only times since the Fed has introduced quantitative easing, which was in the 2000s, the early 2000s, is when they slow down spending, that's when we see either stagnation in the market or we see a decrease. And so what we see here is this blue line is QE. When it leveled out, in this first this beautiful blue circle, we see the stock market actually crash and consolidate for years. And then here in 2018, when they reduced again, we also saw the market eventually have that deep crash, which was for COVID. And so if we see the QE start to taper again, we could also see the stock market about to pull back and or crash. Overnight repos, very confusing topic, but what I want to call here is we're just seeing outlandish numbers. We're seeing twice as large that we've ever seen, and the last time we saw levels even close to this high was at the housing market crash, and we're more than double that level. So the Fed is doing a lot of things that we don't typically look at on a day-to-day basis, and we need to start paying attention to if these numbers keep going up and stay around here, or if they start reducing. But if they keep it up here, that's another really big red flag. CPI numbers, this is something that's been a concern for a lot of people recently because we've seen the largest percentage increase in CPI since 2008. That's a lot of years, and we all know what happened in 2008, the housing bubble crash. And so this is something we need to pay attention to. The Fed is saying it's transitory, but we don't know if it's transitory yet. It could persist, it could keep going. So if we see that CPI continue to go up or hang out around this 5% range, that could call for more of a potential market top. Another thing I want to talk about is more retail investing. So we've seen retail investing grow substantially since COVID happened. If you see these lines, basically heading around this like under 2 billion to where retail investors were up to 8 billion of the market in terms of equity buying. Same kind of thing here. We've just seen this insane growth for retail investing trading. And why that's important is when we see more retail traders participating in the market, it typically means we're in a more speculative time. You know, what we see here is during the housing bubble crash, we saw a little peak there, and that's when we saw the big market crash. At the beginning of 2021, when the market went insane, we saw the Google search how to invest in stocks reach by far the highest level that it ever has. And so this is another sign showing there's a lot of speculation happening in the market. So when we kind of combined all the aspects where we look at the Fed spending, we look at PE ratios, plus we see the growth of retail investors, all the things kind of point and prove that Michael Burry might be right about him calling out a stock market crash coming up soon. But now I want to look at some reasons about why the stock market potentially could still go higher for the next couple years, and we haven't quite reached the peak. So the first thing I want to look at is how much trading has been happening on the market. So this is for the equities market, and it's the average daily volume. So 2021 so far is double what we saw in 2019. And this is a bullish because what we're seeing is a lot of buying. Typically in the market, especially with the growth of retail investors, we see much more buying to the long side than shorts to the downside. And so with so much more trading happening, with so much more purchasing happening, and it looks like this trend is still showing upwards momentum, that we potentially have a few more years till we see a market correction or a significant crash happen. Next thing I want to look at is the federal fund rate. Because it's so hard to say, I'm just going to call it the FFR. But the main thing I want to call out here is look how low the federal fund rate is right now. Basically, the FFR is at a 0. And when we look historically speaking, the only times we see a stock market crash is when we saw a peak in the FFR. So during the dot-com bubble, we saw a peak here right before the crash. During the housing bubble, we saw the federal fund rate hit a high before it crashed. And what a lot of people don't know, we actually saw the FFR kind of start going higher prior to the COVID crash. So even though maybe COVID had an impact, there were other factors that had an impact on the market pulling back so much. And so I think until we see the FFR significantly go higher, we can potentially not see a crash in the market. And when we look at what the Fed is saying, they're saying they're going to keep the FFR low all through 2021. They're going to start increasing a little bit in 2022 and 23, but we're not going to see any significant long-term growth in the rate until past 2023. So as we're kind of putting all the little dots together with like how the federal fund rate has such a big impact on whether the market's moving up or down, we could still have a few more years until the FFR gets to a point where it actually has a negative impact on the markets. The next thing, we looked at this as a positive to Michael Burry's argument, but we also want to take it as a con to his argument, or saying that the market still has time to run, because the Fed supports the market. And when the Fed's spending more, typically stocks move higher. And the Fed has talked about tapering, but we don't know how much. We don't know when. They've talked about pulling back spending, but we don't know when that is. And based on what I'm seeing on this chart, is we're still on an uptrend, and it doesn't look like that's slowing down. And so that's going to have a really big impact on the stock market potentially moving higher. Now that we've kind of gone through all those topics that I sped through, I want to know what you think in the comments. Please let me know if you think we're hitting a crash soon or if we still have a few more years. But let's look at the long-term chart to see the things that are pointing to a crash and the things that aren't pointing to a crash. And so the first thing I want to look at is the RSI. So what we see on the RSI is unless the RSI goes under a 45, we're not in a bear market. And so for the dot-com bubble, we saw RSI go under 45, and during the housing market, we saw the RSI go under 45. Those were the only last two significant bear markets, and since then we haven't seen RSI go under 45. We've seen it hit 45, we've seen it tap it. Even during the COVID crash, it only tapped 45 on the RSI, and it wasn't a bear market. And so until we start seeing that curl around and get lower, the market is still in a bull market, in a bull run. On the more negative side, in terms of we could see a correction or a crash, is the divergence that's happening. And so basically what that means is on the RSI, we're seeing the line go downwards, but we're seeing the stock market go upwards. And so typically when we see that happening, that's telling us that there's going to be a correction or a pullback coming up relatively soon. So that's something we want to keep an eye on, is how much longer can that divergence happen. If we go back to the dot-com bubble, the divergence started back in 1996, and it went all the way to 2000, 4 years of divergence. During the housing market, it was much shorter. It was about a year of divergence, and during COVID, we were at about 2 years of divergence. And so divergence can last a year up to multiple years, and that's something we want to look at. Another indicator is the MACD. So the MACD we see hitting the highest it's ever hit in the history of the stock market. And so the question that I'm starting to wonder is, have we seen a peak in the MACD, or does the MACD have more positive momentum to the upside? And the last point is kind of the long-term price ranges that we've seen in the S&P 500. And so basically starting in 2021, during this crazy run that we've seen actually asset prices in the S&P 500 break above the long-term channel. And so this is something, we see this one uptrend here. If we see this break below that, we definitely can see the stock market come back and testing the top of that long-term range. And if it breaks down to low, we could see it start coming back in this range. And so that's going to be a drastic pullback, as the top of the range is, still at like about 3,700. But deep in this range is much lower, around the 3,000 range for the S&P 500. So those are a couple of pros and cons on the chart of where that now we want to look at in the short term, where could the S&P be headed in the markets. So on the weekly chart, we do see that this last week we did break below the COVID trend line. And so I think that's calling for two things. I think first we're going to see a short-term pullback to this gap fill at 400. And then I think eventually by August, we'll probably see a 10 to 15% market pullback. And the reason I say that is, one, we're seeing the MACD start to show negative momentum. And we've been in this oversold territory on the weekly basically since, since July, August range. And when we look at the daily, two important things that we see is the 100-day SMA is at the $400, which is where I called out for us potentially to pull back to that gap. And the second thing is the 200-day is actually at that 10 to 15% pullback range, which is also around this consolidation time. These two big red circles are showing consolidation on both of them. It's kind of sideways movement. What does that mean? And typically when we have large pullbacks, we pull back to an area of consolidation, which is somewhere between that 360 and 380 range for the S&P. So just to sum up the video, I want to cover everything we talked about. So Michael Burry, one thing to call out when I did my research is he's not calling a crash till as early as 2022. What you have to think about is Burry is a macro thinker, which is big picture. So sometimes he makes calls without without really defining when he sees it happening. And until we start seeing the Fed taper and interest rates go up, or the FFR, the federal fund rate, go up, the market still could have some more time to go. And people aren't always right. So Michael Burry could be making a premature call, is something to think about. I personally think that the markets could potentially push higher, but we do need a short-term correction to get people more excited about the market. And I think there's areas of the market that are overvalued and areas that are not. And the last thing, don't sell out of the market. You'll lose more money that way. But thanks for watching the video. Please like and subscribe. Leave something in the comments. I want to know what you have to say. I appreciate you tuning in.